Quick note, when I say options in this video, I'm specifically talking about stock options. All right, now options are a derivative of stocks, meaning that their price is derived or linked to the price of a stock. Remember, this is really easy. There's only two kinds of options. There's calls and there's puts. Now, the easiest way to remember which one is which is the owner of an option wants the stock to move in a direction, either up or down. Now, just put the name of the option, call or put, and then say someone after it, and then ask yourself which direction makes more sense. For instance, do you call someone up or do you call someone down? Do you put somebody down or do you put someone up? Now, when you buy an option, it's important to think of it like you're actually buying it from a person. And what you're buying is a digital contract. Now, the person who sells the option creates it, or in options lingo, they write it because they are the writer of this digital contract. The owner or the person who buys the option has the right to do something or not to do something. That's why it's called an option, because you have the option to do something or not to do something. And what you have the right to do is buy, if it's a call, or sell, if it's a put, 100 shares of a stock at a specific price for a certain amount of time. Now remember, when we're talking about options, keep it 100, always 100. All right, so all contracts are written the same and only have 4 parameters that change. Let's take a look at what a contract is saying. Now, keep in mind, this isn't a real contract. I just wrote it as simple as possible so that it makes sense and it's easy to understand. When I put can here, maybe the right word was may, but when I wrote can, I was implying that this means that you have the choice. You don't have to do it, but you can if you want to. Now, if you do it in options lingo, this is called exercising the option. Now, right here, the stock name in options lingo is called the underlying. And the amount in options lingo is called the strike price. And the date in options lingo, well, they kept that one easy for us. It's called the expiration date. So if you think about it, all call options for a stock, let's just make one up and call it ABC, are actually the same except for just 2 things that change: the strike price and the expiration date. And depending on what those 2 things are will affect the price of the options contract. All right, now the price of an options contract is determined by what somebody is willing to sell it for and what somebody is willing to buy it for. You can actually see this when you look at an option. There is a bid price and an ask price. When you see bid, think B for buy. You know, if you're at an auction, buyers make bids. That's what somebody is willing to buy it for. And then the ask price is what the writer or creator of the option is trying to sell it for or willing to sell it for. When the bid and the ask price are equal, a trade is made. In options lingo, the price is called the premium. So to understand how these 2 inputs, the strike and the expiration date, affect what somebody is willing to sell or buy the option for, let's take a look at a call option. In options lingo, the value, what somebody is willing to buy or sell it for, is separated into 2 categories: intrinsic value and extrinsic value. An option has intrinsic value if the owner could make a profit by exercising the option. If they cannot make a profit, then it has no intrinsic value. So for intrinsic, think inside. It's the value that's in the option if you exercise it. So let's walk through an example. Let's say that the stock ABC is currently trading for $10 a share on the open market, meaning you could buy and sell ABC for $10 a share right now. Does a call option for ABC that has a strike price of $9 have intrinsic value? Well, if you were to exercise this option, you would buy 100 shares at $9 a piece. Then if you were to immediately turn around and sell that back to the market for $10 a share, you would make $1 on each share. Since there's 100 shares, you would profit $100. So yes, it has intrinsic value, $100 worth to be exact. So it should be easy to understand why people would be willing to pay for that option, because they can exercise it for a profit. Now let's pretend that the strike price is $11. Does this option have intrinsic value? Well, if you were to exercise it, you would pay $11 per share. Then you immediately turn around and sell it to the market, but you're only getting $10 per share. So you would lose money. So no, it doesn't have any intrinsic value. Now it's completely natural to think, wait a minute, why doesn't it have negative $100 in intrinsic value? And that's because, remember, it's called an option because you have the option to exercise it or not exercise it. So if exercising the option would cause you to lose money, then you would choose not to exercise the option and not lose money. This is why options have positive intrinsic value or just no intrinsic value. Now in options lingo, there are three phrases: in the money, out of the money, and at the money. If you are in the money, it means the option has intrinsic value. So think in the money means intrinsic value, which means you could exercise it for a profit. So if you are in the money, you would get money for exercising the option. Now out of the money is the opposite. So you would actually lose money for exercising the option. So think out of the money, you would be out some money for exercising the option. At the money is when the strike price and the stock price are the same, are equal. So you wouldn't gain or lose any money if you exercised it. So think at the money means strike price is at the stock price. Okay, now would anybody be willing to buy this option that is out of the money? Intuitively, you might be thinking no, in which case, great job, you are right, but only if the expiration date is right now. So let's imagine you change the expiration date to 2 years. Now, would anybody be willing to pay for this option? The answer is yes, specifically people who think it's going to go up. Remember, you call someone up. If it's hard to understand why it has value, think about it like this. Let's say that stock ABC is Apple or like Apple, which has mostly gone up over time. Now, would you be willing to pay for this option? And what if it was just 1 penny? Think about it. What is the worst case scenario? You lose 1 penny, but you're going to pay that penny for a chance to win. What if it goes up $15 just in the first year? You could exercise this option, meaning you would buy 100 shares at $11. Then you could turn around and sell them on the market for $25 a piece, profiting $14 a share. And since we keep it 100 with options, that's $1,400. Pretty good deal, right? Okay, so now knowing that, would you pay 2 cents? How about 3 cents? Whatever the amount someone is willing to pay or sell an option for that is out of the money or has no intrinsic value, that amount is called, you guessed it, extrinsic value. Now it's fairly easy to understand how the more time an option contract has, the more likely the stock price will eventually move in the direction the owner of the options contract wants it to. So the more time an options contract has, the more extrinsic value it has. So a good way to think about extrinsic value is what is the likelihood of a stock moving in the direction the buyer or the seller wants it to. Other than time, there is one other factor that affects the likelihood of a stock moving. That factor is called implied volatility. And the way you can remember what volatility is think violent for volatility. Look at these two stocks. This one is smooth, calm, relaxed, while this one is erratic, jumpy, and all over the place. Or you could say this one looks more violent, aka this stock has more volatility. Now, when you're predicting the volatility that will happen in the future, it's called implied volatility. If a stock is expected to jump around vigorously, violently, or with high volatility, the higher the likelihood that it moves in the desired direction for the given amount of time. So the more likely it is to be up or down, the more someone would be willing to pay for that option. I hope that intuitively makes sense. So to recap, remember, more time means more extrinsic value. More implied volatility means more extrinsic value. Okay, now that you understand extrinsic value, it should be easier to understand why if you own a call option on a stock that went up in price enough to where you could exercise it for a profit, you would actually be better off selling that option rather than exercising it. And this is the reason why options usually only get traded, which just means they get bought and sold, as opposed to getting exercised. Usually the only time options actually get exercised is when they expire. To help us understand, let's walk through an example. Let's imagine that 1 year ago, you bought a call option. It was a call with a strike price of $130 and it expired in 2 years. After the first year, the stock has gone up to $150. And now you want to get out of that call option and collect your profit. Well, you could exercise it and buy 100 shares at $130, then immediately sell them to the market for $150, making $20 on each share. And since there's 100, that'd be $2,000. Or instead, you could sell that option to someone else. And what you could sell it for, well, the option has intrinsic value. We just did the math on that, which was $2,000. But it also has extrinsic value. So you could actually sell it for more than $2,000. If you're wondering how much more, it depends on how much implied volatility and how much time it has. And it still has a year to go, so it'd be substantially more than $2,000. The point here is to show you why it's rare for someone to exercise an option before it expires, because they're giving up that extrinsic value. So exercising most commonly happens at expiration. There are some other times when it makes sense to exercise before expiration, like if the underlying stock pays a dividend. If that dividend payment for owning 100 shares is greater than the extrinsic value, then it could make sense to exercise it so that you own those 100 shares and get paid that dividend. Understanding extrinsic value and how time and implied volatility affects it is key to really understanding options. If you can grasp these concepts, you're ahead of beginner option traders. Beginners often don't understand why a drop in implied volatility will reduce the price of an option. In options lingo, this is called IV crush, or implied volatility crush. A drop in implied volatility can actually be greater than the increase in value from a stock going up. So it is possible to buy a call option, have the price move in the direction you want, meaning it increases, remember, call someone up, but your option price decreases. Can you think of another way you could buy a call, have the price go up on the stock, but still lose money, even if the implied volatility stays the same? Remember, the likelihood or extrinsic value is affected by both time and implied volatility. Less time equals less extrinsic value. So that's the other way that you can buy a call option, have the stock price go up, but the price of the option actually decreases. That happens when the time decay reduces the extrinsic value more than the stock price going up increases the intrinsic value. Now you might be thinking, sheesh, sounds terrifying and difficult to know how to value options. How on earth are you supposed to keep all this stuff in your head? In which case, you're right again. See, you are getting this. Options are too confusing and difficult. Never trade them. That's the end of this video. See you later. Bye. Of course I'm kidding, but don't worry. There are tools out there like options calculators and what's called the Greeks that can help you and other market participants make decisions for valuing and trading options. But I do want to stop and say congratulations. If you've comprehended everything to this point, you understand the basic concepts of what options are and how they get their prices. And in my humble opinion, understanding that concept is actually rare, but it can really give you a deeper understanding of options trading. It's kind of like somebody knowing 4 times 4 is 16, but not really understanding how or why. That person might run into a little bit of trouble if they start trying to do some complex multiplication. Okay, so this is where most people are going to throw in the towel and say, I don't get options, they're too complicated. But stick with me, listen to what I'm saying, rewind and rewatch if needed, and I promise you, you will get this. You can look at the cheat sheets I provided down in the description below to help study this and really solidify this stuff in your head. I've mostly been talking about buying and owning options, but now we're going to talk about actually selling them. Earlier, if you had the thought, gee, it sounds better to write or sell options rather than to buy them, that's a good thought, and in my opinion, it's true, but there is a catch, and that catch is collateral. Okay, so let's say that you want to write or sell a call option. You would need to fill in these blanks and then put this contract up for sale in hopes that someone will buy it. Now, you just can't write a call option without collateral. So it's important to know as the seller, in order for you to be able to write or create an option, you have to make sure the buyer or owner can exercise it and do what the option is saying. So a call option says the buyer, the person who's going to own the option, can buy 100 shares at this price, the strike price. So you, the seller, are responsible for providing those 100 shares at that price if the buyer decides to exercise it. So you either need to own 100 shares or have the ability or right to get 100 shares of that stock to make good on that promise. When you own 100 shares and you create or write a call option, in options lingo, this is called writing a covered call because you own 100 shares to cover that call. Now you might be thinking, what does he mean have the ability or right to get 100 shares? Well, if you think about it, that is what an option is. You can get 100 shares of this stock at this price for this amount of time. So if you own an option, that can actually be your collateral to show you can make good on that promise of providing 100 shares to whoever buys that option that you write. So you can buy a call option that gives you the right to 100 shares at a specific price for a certain amount of time. Then because you own the right to those 100 shares of a stock, you can now write or sell an option that gives someone else the right to buy the shares. You can actually do this simultaneously as one trade. This is called a multi-leg options strategy. This is where it gets harder and harder to comprehend, which is also why some trading platforms won't even allow you to do this right away. They want to make sure you understand simple option trading first. And that would be a whole nother video where we would build upon the concepts we learned in this video. If you want that video, just let me know by commenting down below. These multi-leg option strategies have names like spreads, strangles, straddles, iron condors, and butterflies. But the point I'm making here is you need collateral to write an option. The simplest way to write a call is to have 100 shares. Now, what's the simplest way to write a put? Well, let's think about what the contract you're writing and attempting to sell says. You give the buyer of this option contract the right to sell 100 shares of a stock at a certain price. Now, if the price of the stock goes below the strike price, then that buyer could buy 100 shares from the market and then turn around and sell them at that higher strike price for a profit. But who is going to buy those 100 shares at that higher price? You, the seller, are responsible for buying those shares from them. So you need to have cash to buy those 100 shares at that price as collateral. This is called selling a cash secured put, because you need to have the cash secured in order to be allowed to write or sell that put option contract. All right, you're doing great. We're getting close. Now, let's visually put this all together. A lot of trading platforms are going to show you a P&L graph. So I'm going to switch over to my computer and show you the P&L graph and explain what's going on, and then we can derive a lot of awesome key concepts that'll be super valuable in helping you understand and trade options. All right, so let's make a simple profit and loss chart for a call option. So on this x-axis here, this will be our stock price, and over here this will be 0, and this can go to infinity. It can be a lot. So if you have a call option, it's going to allow you to buy shares at a certain strike price. Let's just make that strike price right here. And it's going to allow you to do that for a certain amount of time. So let's chart what our profit and loss will be when the option expires, when there is no more time left on the option. So if you think about it, let's say that the stock price ended right here at the time of expiration. If you were to exercise the option, you would buy 100 shares at this price right here. Then you could turn around and sell them for a higher price because the market price is right there, so that would be a profit. So all the stock prices on this side of the strike price would be in the money. And then if, let's say that the stock price ended right here, well, if you bought at the strike price and then you tried to turn around and sell it, you would sell it for less than you bought it for, so you'd actually make a loss. So everything on this side is out of the money. And then of course, you guessed it, at the money is where the strike price and stock price equal each other. Now let's plot how much we'd make or lose depending on where the stock price ends. So we're going to put that on the y-axis here, which is going to go from 0 to a lot of profit or 0 to a lot of loss. So how much money would we lose if it expires over here out of the money on any of these points right here, the stock price? Well, it would be however much it costs you to get into this option, the price of the option, which in option lingo is called the premium. So let's just mark that right here. And the distance from here to here, whatever that amount is, because it's the premium cost. And it really doesn't matter where the stock price ends, we're always going to lose that max amount, whatever we paid for the option, until we get to the strike price. And then once we get to the strike price, if the stock price goes up $1, well then now we can exercise it for $1, which would make us go up $1 here. Not yet a profit, but $1 more than our max loss. $2, we'd come up here. $3, come up here. Because if we just pretended this was, say, 10 bucks, well, when it's 11, we're going to buy for 10, turn around, sell at 11, that's $1 profit. When it's 12, $2 profit. 13, $3 profit. So it's going to be a linear relationship. When you plot it out, it's going to look something like this. So it's going to be a straight line up and to the right like that. Now there's a unique point right here, and this is where we don't lose any money or where we break even. We can actually calculate what the stock price needs to be to break even. And then any stock price above that will make a profit. And since the stock price can keep going up, our profit can keep going up. So technically, there is no limit to how much money we could make from owning a call option. And it's really important to remember this is a call option, profit and loss at expiration. Now we're going to come back to this in a minute and see what happens when we're not at expiration. But real quickly, let's chart out what it would look like for a put option at expiration. So again, we've got our stock price, and it goes from 0 to a lot. And then we'll put our strike price right here this time. Now, if the stock price ends up right here at expiration, what is our profit and loss going to be? Well, if we think about it, a put option is saying that we can sell 100 shares at this strike price. So if we were to buy it from the market at this price and then turn around and sell it for more, we would actually make money. So on the left, this is now in the money, where above in the money was on the right hand side. So it's the opposite for a put. And then again, if we were to end right here for the stock price, well, we would buy above the market value, then turn around and sell below the market value. So we would actually lose money. So everything on the right now is out of the money. So what does our max profit and loss look like for a put option? Well, again, the most we can lose is what we paid for the option. So it's worthless on this side. No matter what the stock price ends up at, we just inquire our max loss. So our max loss is, again, the premium amount. And then again, for every dollar the stock goes down, we make an extra dollar in profit. And now our line looks something like that. Now you might notice there is something unique with a put, is we can actually calculate where these two lines intersect for a max gain or profit. And we can calculate our break even, and then all of this is our profit and all of this is our loss. But this is only at expiration. Alright, thank goodness for computers. They make everything a lot easier, especially making this video. So a very popular, awesome tool, completely free, I definitely recommend you check it out, is called optionsprofitcalculator.com. It's completely free. If you go there, this is what it looks like. We want to look at that call option that I made, that chart, and we just want to have the computer chart it out so we can look at some more stuff, and it's just much better at drawing things than me, so I'm going to be able to show you more and teach you about things a lot easier on here. So we're just going to use Apple as our stock. So that would be the underlying. Remember, options lingo, that's the underlying. All right, so now we're going to select the option. We are buying a call option, right? So we're going to hit this here, and you're going to see this is the option chain, which up here shows all the expiration dates of options. And then here's our strike price in the middle here. On the right side, we have our puts, and on the left side, we have our calls. And you can see this is the last price it got, was at 173. And then like I mentioned earlier, we have our bid price, what people are willing to buy it for, and our ask price, what people are willing to sell it for. This mid stands for like the middle price of what it should sell for based on the bid and the ask. Let's go 1 year out. So right now it's actually January 14th, 2022. So I'm going to do this 20th of January 2023. So let's go ahead and use 155, which would be in the money. It shows what the price is per option. Remember, keep it 100. So it's not $30, it's actually $3,068. You just move that decimal place over to. I only want to look at one contract. I'm going to press calculate. Okay, and a lot of times you're going to see a chart like this, but if you click here, you can see some lines, and then we're going to go ahead and change this to profit and loss because I want to show you what we had drawn earlier. So if you remember, we went from 0, we showed this 0 over here, and we just went to a lot. I'll put 500. So you can see here, this looks very similar to what I drew. And all these extra lines here are just showing the profit and loss at different times. So this green line down here is going to be 21st of January 2023. That's at expiration. So you can see our max loss here that stays the same, right? 3,068. That's the cost of the option or the premium. And then right here at our strike price is when the max loss is no longer incurred and it starts to actually go up and to the right. All right, so let's go ahead and try to zoom in on this and see what's going on here. 100 to 250. All right, now it's much easier to see that bottom line, the expiration profit and loss, right at 155, our strike price, is where it starts to go up and to the right in a linear fashion. And you can see these other lines, they have dates associated with them. That is the profit and loss at different dates. So if we got rid of all those and just had this expiration one, you could see we recreated what I drew. And as I said, the computer is much better at drawing straight lines than I am. Now these curved lines here are the profit and loss charted at different times before expiration. They actually list the dates right here. So you can see if we were to look at this March 15th line, it's showing what your profit and loss would be for the different prices of the stock at that given point in time if you were to get out of the option then. And you can see that all of the P&Ls that happen before expiration are worth more because they not only have the intrinsic value that this expiration line has, but they also have extrinsic value. You can also see that extrinsic value is greatest at this 155, whatever the strike price is. And as we move farther and farther in the money, extrinsic value becomes less and less. And the further we move out of the money, extrinsic value also becomes less and less. So I'm going to use this illustration and these different profit and loss curved lines to show you what the Greeks are and hopefully help you understand how you can use them in your options trading. All right, so I do think it is important to remember that it's not the Greeks that make the price of options. It's the market participants, the buyers and sellers, that actually create the prices of what options are. However, there are mathematical formulas like the Black-Scholes model and the binomial model that do an incredible job at predicting human behavior and therefore what the premiums of options will be, the actual prices of the options. And it does this by taking known variables that affect the prices or the premiums of options and then solving for the premium based on what those variables are. The Greeks are some of the variables used or derived from these formulas. So solving for or knowing what these Greek variables are on an option can be extremely useful and give you information about an option and how its theoretical value should change given a change in one of these variables. And what's great is today nearly all trading platforms do this complex math for you and just tell you what the Greeks are. But I just think it's important to understand that, and like if you actually just look at the Greeks on an option during market hours, you'll see that they're constantly slightly changing. And this is because all those variables used to solve for those Greeks are also slightly constantly changing in real time. So the Greeks you see and displayed aren't set in stone. They're just showing what they happen to be at a very exact specific point in time. So this options calculator right here is actually using the Black-Scholes model to draw out these lines, these profit and loss charts at different points in time. So let's try to understand this a little bit better and what this all means and how this can help us. All right, so we're going to go over the Greeks and we're going to use that word association, alliteration type technique to help you remember this stuff. So the first one we're going to go over is theta. So think T for theta, T for time. Theta is going to show you how time affects an option premium or the price of the option. All right, so let's look at these lines here. I'm going to zoom in a little bit. Let's zoom in, we'll go 155 to 170. Should be able to illustrate what I'm trying to explain here a lot better. So hopefully you can see the distance between this line and this line is smaller than the distance between this line and this line. And you can see the distance apart from each line keeps getting bigger and bigger. Even though these are spaced apart by a month, you can see with each passing month, the amount of profit lost gets less and less. And this is time decay. And what theta actually is it shows you how much the option premium, if everything else stayed the same, how much will the premium get reduced by in one day? That's what theta is. So if we were to imagine that these were days and we actually looked, okay, here's the value, 721, 829, the difference there, we could say that that is theta if this was just one day. It's not, so it's not theta, but that's what it would be. But then you'll notice the very next day, it actually goes down by more. So hopefully you understand that idea that theta, time decay, is accelerating, and it gets bigger with each passing day. So I'm just trying to demonstrate how time decay reduces an option's value at an accelerating rate. So if you were to buy an option, it's going to cost you money to hold that option every single day if nothing else changes, if that stock price doesn't move. And the closer you are to expiration, the more you're going to lose each day. So you're going to suffer the most time decay when you buy very short options that expire in only like a week or two, versus if you bought an option that's going to expire in 2 or 3 months, you're going to experience way less time decay on a daily basis. All right, now let's go back out. All right, so remember, extrinsic value increases or decreases with the amount of time that's left on an option, as well as how much implied volatility is on an option. So you can see right here, this is the implied volatility change. If we were to increase it, say by 25%, what will happen to these profit and loss charts? Well, if you think about it, more implied volatility means more extrinsic value. So they should increase, right? They should go up. And you can see they did. And then if we decrease it, they'll go down. So this next Greek is called Vega, and think V for Vega and V for volatility. And really what Vega is showing is for a 1% change in implied volatility, how much is this option premium going to increase? So if we were to just put 1% here, a 1% increase, it might be hard to see, but this should move very, very slightly. And then if we had a plot for today expiration, this is a month out, so we'll just assume this is the today. Whatever that moved by, the amount with that 1% change in implied volatility, that is what Vega is. Now it's important to keep in mind, implied volatility rarely only moves 1%. So think about that when you're looking at Vega. But this happens a lot around earnings. There's a lot of uncertainty, a lot of volatility because you just don't know what's going to happen. There's information that's not complete, not there. And then earnings come out. And now that we have more information about the company, the implied volatility often goes down. And that's how you get that IV crush. All right, so let's zoom this way out again. We'll go 0 to 500. Now remember when we plotted this expiration profit and loss, that our max loss stays the same, that 3,065 in this case, until it reaches the strike price, and then it starts going up and to the right. Remember I said it was a 1-to-1 relationship, which basically meant it's linear, or for every $1 increase in the stock price, the premium price, which is expressed like this, would go up by $1. And technically, if we keep it 100, it would actually be $100. But the point is, it's a 1-to-1. You know, every time it goes up $1 on this axis, it's going up $100 on this axis, and gives us that nice linear line here. But we can see before expiration, when it has extrinsic value, it's a curved line. It's not linear. And you can see it's most curved right at that strike price. And as it goes further and further in the money, it eventually gets really close to being that straight line, or having that 1-to-1 ratio. And then as it moves further and further out of the money, it gets closer to being a 0-to-1 relationship, meaning stock price goes up $1, the premium price doesn't move at all. It just stays at max loss. So you can see how it changes. It shifts from a 0-to-1 relationship to a 1-to-1 relationship. Now let's zoom back in and take a look at this. So we can see at 155 here, we've got a loss of negative 3,065. If we go up $1 to 156, well, now it's 29.65. Another dollar, 28.65. 27.65, 26.65. Now if we were to look at something like this February 22nd profit and loss, you'll see that it's not going up in a 1-to-1 ratio. You can see we go at 155, we're at 11.96, go up 1, now we're at 11.40. And if we do the math on that, 1196 minus 1140, it's 56 difference. Okay, and then if we go from 156 to 157, so it's 1140 to 1082. 1140 to 1082. You'll see now it's 58. So you can see it's changing as it's moving. So this first time it went up 56 from that first dollar, but then on that second dollar it went up 56 plus 2 more. So for delta, I just think D for difference, but the delta shows what's going to happen to an option premium if the stock price goes up by 1. So if you're at 155 and the stock price goes up by 1, well then the delta is going to be 0.56 because it went up that 56. And the premiums, they're expressed like this, so the delta would be expressed as 0.56, or you could think of it as, yeah, it's a $56 difference. But then that next dollar increase, well, delta was more than that, right? So there's another Greek, and it's called gamma. And I don't have the best alliteration way to remember it, but I just think gamma shows how much delta is gonna change. So in that case, gamma would be 0.02 because delta is that 0.56, so it goes up $56. And then gamma is saying that, hey, delta is going to change by 0.02 or $2 since we're keeping it 100, remember? So delta is showing at this point in time, if we were to chart out today's profit and loss, delta is showing how much your option premium is going to increase or decrease with a $1 change in the stock price. And then gamma shows how much delta will change for a $1 increase in the underlying price. So as you can see, delta is a moving target. As the strike price continues to increase, delta will keep increasing closer and closer to that 1-to-1 ratio, to getting to 1. And as the stock price decreases, delta is going to decrease and get closer and closer to 0. So delta is always between 0 and 1. Or if you're keeping it 100, you could think of it between 0 and 100. Now that's for calls. On puts, it's actually between -1 and 0, but it's the same concept. There is another special unique property of delta that we already hit on, and that's the fact that as we get closer and closer in the money, it gets closer to 1, and as we get closer and closer out of the money, it gets closer to 0. Let's zoom out again. You can really see that. It goes from 1 to 0, and as we get close to this strike price right here, it gets closer and closer to around the middle, or 0.5. So another neat thing that delta gives you is the rough percentage or likelihood of the option finishing in the money. So at the money, delta is near 0.5 because assuming that stocks are random, 50% of the time the stock will go up in the money and 50% of the time the stock price will go down out of the money. As the stock price moves up, the closer delta reaches 1, or the option gets closer to having a 100% chance of finishing in the money. And as the stock price goes down, delta approaches 0, or a 0% chance of finishing in the money. So that's just another unique characteristic of delta that you can use to help you trade options. All right, so there is actually one more Greek that I do feel obligated to mention because you're going to see it and wonder what it is, and it's rho. And I just think R for rate, and it's showing how much an option price will move with a 1% change in the risk-free interest rate. So what that risk-free interest rate is showing is like, hey, if I were to put my money somewhere, normally you can collect interest from it. And risk-free meaning just that it's like a super risk-free investment. Like I'm almost guaranteed to get this interest rate for storing my money here. And depending on what that rate is will affect option premium. But in reality, rho is super unhelpful and not really useful and rarely ever even looked at. There's a few reasons. The two main being is, on shorter expiration dates, rho is such a small amount that it doesn't really affect the option premium. It could on like maybe a 2-year option contract. But the other reason is, interest rates in the US have remained relatively low for a really long time now. And the small movements that it makes really doesn't affect option pricing in a meaningful way. So rho is there. Maybe one day if we have very volatile interest rates and they're high again, it could be useful, but it's not going to be useful anytime soon. And you really don't need to worry about it. But at least now you know what it is and know why it's displayed on some option trading platform. All right, so now I want to show you how to actually trade options. I'm going to show you how to do it simultaneously on 2 different platforms. I chose Thinkorswim, which is a TD Ameritrade platform. One big reason I chose that is because they allow you to use fake money to trade options. And I feel like that's going to be the best way to learn it and not have any, big consequences by making a mistake. I think they give you $200,000 to just play with and trade options in real time with real stocks to see and learn how things work. So that was one platform I used. The other platform is Robinhood. You'll see I'm doing that on my phone, so I'll have both up at the same time, and I'm going to do the same trades and just show you how you get into an option and get out of an option So let's just jump back into my computer and see how that works. All right, let's walk through how you would actually buy or sell an option. All right, now first thing is you'll want to buy or sell options during market hours. If it's outside of market hours, you can put in an order, but it's not going to actually go through until the market opens. Just keep that in mind. So the first thing you want to do is go to the stock or underlying that you'd like to see the options on. For this example, I'm going to use a stock called Salesforce, stock ticker symbol CRM. So on Thinkorswim, just type it into the search bar. Same thing for Robinhood. Down at the bottom, press the search icon, CRM. We're going to click on Salesforce and we're going to get some information about it. Now, if you don't see this on Thinkorswim, make sure you press trade here. It might look like something like this. Press trade over here and you're going to have this options chain right here. So click on that and it'll bring up the options. For Robinhood, you're going to press trade bottom right and you should have the option of trade options come up. If you don't, you're going to have to go into your setting and let Robinhood know that you would like to trade options in order to see that, which of course I've already done. So I'm going to press trade options. Now, this right here is showing all of the expiration dates on both. It's vertical on Thinkorswim and horizontal on Robinhood. So you can see these are all the different expiration dates for options that are being traded. So you're going to pick which one you'd like to see the options on. We're just going to use March 18th for this example. Just click on it on either platform and it's going to bring up the options with that expiration date. Now they're organized differently on the different platforms. For Robinhood, you'll see at the top right there's a toggle between call and put, and you're going to toggle between the two to see calls and to see puts. On Thinkorswim, calls are on the left, puts are on the right. Now you'll notice there's this divider line right in the middle on both platforms. On Robinhood, it's got the actual share price, and that's dividing in the money and out of the money options. So for call options, they're kind of reversed or flipped. In the money options for Robinhood are all the options below that middle divider, where on Thinkorswim it's what's above that middle divider, simply because on Robinhood the strike prices go from high and then down to low, and on Thinkorswim they're flipped to where it actually starts low and then as you go down the strike price gets higher. You can see here's the strike price, here's the bid and ask, and then here's some more information about it. Now this information on Thinkorswim, if you press this little gear icon, you can adjust what you'd like to see. So you can see I've got volume, open interest, the Greeks, delta, gamma, theta, Vega, and then I also have implied volatility. These are some extra things that if you wanted to see, you just press the plus button and it'll include it in there, and then you can get rid of it by pressing the negative button there. Now for Robinhood, you actually have to click on the option. It's going to show you all the metrics that could be of interest to you. So you can see our Greeks are at the bottom, and then up above we've got stuff like open interest, volume, implied volatility, yada yada. So let's talk about two very important ones that we haven't covered yet, which is open interest and volume. So you can see on Thinkorswim, you can see the open interest and volume on all these different options, which can be really helpful because it's going to tell you how liquid an option is, which basically just means how easy it is to get into it or get out of it. In the future, if you're wanting to close out the option and it's not a very liquid option, you might have trouble doing that. But if it's a very liquid option, meaning it has a lot of open interest and daily volume, it'll be a lot easier. So the open interest is just showing how many actual contracts are open for this particular option. So for this 230 strike price call option on CRM with an expiration date of March 18th, there's 4,860. So you can see if I click on the 230 on Robinhood, it's going to show the same thing, 4,860. And then you can see the volume is also the same, which is 2,199. The volume is showing how many transactions happened for today that are pertaining to this option. So you can see this is a liquid option. There's a lot of contracts that are open, a lot of transactions happening each day. If we go way up here to one of these super in the money options, you can see that there's only one open contract on that and there's no volume. So this would be a very unliquid option and you're probably gonna struggle to get in or out of this option. All right, now let's say that we actually want to buy this 230 call option for Salesforce. All right, so on Thinkorswim, if you just press the ask right here, it'll pull up a buy for you. If you press the bid, it'll switch it over to sell, but you can toggle it back and forth right here. So we're going to say buy, and it's saying 10. We only want to buy one, so I'm going to change that to 1. One call option with the March 18th, 230 strike price. So on Robinhood, you can actually just press the little plus button if you want next to it, or you can click on the 230 call option. It'll bring up all the information on it so you can double check that, and then you can press buy. Or like I said, you can press the plus button, then down at the bottom, hit that, and it'll bring you to the same screen regardless of how you get there. Now you can see in Robinhood it's showing how many would you like to buy. I'm just going to put 1. And then we've got the limit price. So it'll show you the bid and the ask, and then it'll put in gray there the price in between the bid and the ask. So this limit price is what you're willing to buy this option for. If you put the ask price, it will get filled because that's what people are trying to sell it for, so you know it'll be met. If you put the bid price, it should get filled as it fluctuates throughout the day, but there's a chance that nobody's ever willing to sell it for that. So a good common practice is just put a price in the middle. So I'm going to put the 1170 right here. And then you can see on Thinkorswim, it shows you the bid and the ask, and then shows you the middle, this 1170 here. Over here, it's on the ask because that's what we press. So we know we'll get it filled here. But if you want to bring it down to the middle, we can put it at 1170. And then this is saying this is a limit order and it's for today. So you could change this if you wanted to. Definitely recommend using a limit order rather than a market. Market will definitely get filled, but what's nice with a limit order, you just put it at the price that you're willing to buy or sell an option for, and it will only get filled, or that will only happen at that price or a better price. All right, now another great thing that both platforms do, on Robinhood, if you hit the little arrow button above the break even, it's going to bring up a profit and loss for you and display some key metrics like max profit, your break even, and it shows you on the graph. You can go back and forth and actually see what these are. For Thinkorswim, if you come up to the top and you keep scrolling down, you can see your profit and loss here. Another nice thing that Thinkorswim does is you can change this date here to look at different days and what the profit and loss is. So on February 1st, this line right here is your profit and loss. And you can see, if the stock price is at this point on this date, am I going to be at a loss or a profit, which is nice. Where on Robinhood, it's just showing you your profit and loss at expiration. So if you like everything you see, you've checked everything, you like the option and you'd like to purchase it, for Thinkorswim, you're just going to press review down here. It's going to show you, how much it's going to cost, what it's going to do to your account. And again, if you like everything, then you can press send and it will put the order in for that option. And on Robinhood, you put in your prices, press review, and then you swipe up to submit. And that is how you buy a call option on both of these different platforms. All right, I'm going to show you how to buy a put and how to sell a call and a put. But quick note, it is market hours now. This is the next day. That's why the price has changed and whatnot. It does say that I have a call on this 230 here because it did go through. I canceled on Robinhood, so there is nothing there. But for Robinhood, if you wanted to buy a put, in the top right you can see there's a toggle between call and put. You would just put it on put and you can see right now it's on buy. Now if you wanted to sell, you just toggle that buy sell over to sell, and you can see there's calls or puts that you can sell. Remember, like I said, you do need collateral to sell a call or a put, but that's how you would do it on Robinhood. And on Thinkorswim, your puts are over on the right, so we could select this ask price right here on this put, and you can see it's going to automatically bring up this buy. Again, it's on 10. If you want that to change, you can come up to your settings and change your options to default to 1 instead of 10. But we've got buy 1. But just like Robinhood, it has these toggles. So you can toggle between sell and buy, and you can toggle between call and put. And it's going to keep it on this March 18th, but you can change the expiration date or even the strike price. So it's very intuitive, very easy to use, but you would just follow those same steps, select which put or call you'd like to buy or sell for both platforms, and then just walk through those steps that we just went through. All right, now, no matter which one you do, that is going to be called opening a position. In option lingo, you will hear buy to open or sell to open, and it's just implying, hey, I bought and that's how I opened and got into this position, or I sold and that's how I got into this position. Now, if you want to get out of the position, you can sell to close or buy to close, which you're just going to be doing the opposite of what you did in step 1. So you can see here, I have this 230 call option down here, and if we wanted to get out of this, you would do the opposite. So we bought this call option, we would want to sell. Now the easiest way is on either platform is just select it, and you can see it says close selected, so it's automatically going to bring up sell one with all of our parameters in there. You could do it manually too, where you would just come back up here, find the call, and now say that you want to sell it. And the way you would make or lose money is hopefully you bought it at a lower price than you could sell it for, so you'd make a profit. But if you sell it for a lower price than what you bought it for, you're obviously going to be at a loss. So on Robinhood, I'll show you an option I have and what it would look like if I wanted to get out of it. I've got this call option, and I can press trade and then sell, and it's automatically going to pull this one up, and I could sell this to get out of it.